Good morning.
Good morning, Professor.
How are we doing today?
Good, Professor. How are you?
We're doing good. Let me just open my lecture and we're going to get going. So hope everyone is doing well this morning. Our final exam is set for the 25th at 10 a.m. So we got about 3 weeks more to finish up the semester. Let's give it our best shot, do well, and get a good grade for the semester. Today we're going to have a short lecture on chapter 9. And on Thursday, we're going to talk about chapter 11 and 12. So let's go to chapter 9. Let me just share my screen. Okay, can you see my screen? Yes, no?
Yes.
Okay. So today we're going to talk about materiality and risk. In chapter 9, we're not going to cover the whole chapter. We're probably going to cover half of the chapter. The important stuff. The other part of the chapter dealt with calculating risk and the risk model and so on. I'm not going to get into that. When you start working in auditing, you'll have software that does all of that for you. Okay? So no sense we learn all these formulas that we are not going to use. But let's talk about materiality. What is materiality? When we say an item is material, we are saying that it is important enough to influence the user decision. It is important enough to influence the user decision. It can be important enough because it's large enough. It can be important enough because although it is not large, it may be a small item, but it has the ability to make a difference. So when we're looking at materiality have both a quantitative characteristics because of its size as it matters, and a qualitative characteristic. Although it's not large, the circumstances under which it occurs makes it important. And when we talk about risk, we are looking at uncertainty and the likelihood of something occurring or not. So what are some of the things we're going to cover in this chapter? Apply the concept of materiality to the audit. Make a preliminary judgment about what amount to consider materiality. Determine performance materiality during the planning stage. Use materiality to evaluate audit finding, and define risk in auditing. Other things that are discussed, which we are not going to talk about, describe the audit risk model and its components. Consider the impact of engagement risk on acceptable audit risk. We're going to talk a little about that. What's engagement risk? What's acceptable audit risk? We're going to talk about what is inherent risk. But all I want you to know what these risks are. I don't want you to know how you calculate it, how you come about it. And number 9, discuss the relationship of risk to audit evidence. We're going to talk about that as we go along. And number 10, discuss how materiality and risk are related and integrated into the audit process. So first, let's talk about materiality. Materiality is generally a major consideration in determining the appropriate audit report. If you remember going back to chapter 3, where we talk about the type of audit report, if we have a given situation, let's say a departure from GAAP, and it's immaterial, we will issue an unqualified audit report. If it's moderately material, we will issue a qualified audit report. And if it's highly material, we'll issue an adverse opinion. So depending on the materiality level of the item in consideration, it will affect the type of opinion that we give on the audited financial statement. Materiality is also referenced in the auditor responsibility section of the audit report. In the audit report itself, we talk about materiality. If you go back to chapter 3 and look at that audit report. And thirdly, what is meant by the term material? When we say that something is material, we are saying that it is important enough to influence the user decision. It could be important because of its size. It could be important because of the circumstances under which it occurs. What is the auditor responsibility? The auditor responsibility is to determine whether the financial statement is materially misstated. Is the financial statement misstated in a way that will influence the user decision? That's what we are saying there. Is this financial statement misstated importantly enough to influence the user decision? And how much will it influence the user decision? Would it make the whole decision a bad one? Or would it be moderate? So when we're looking at something being materiality, we could classify it into 3 categories. Whether it's immaterial, it's not important enough, or it's highly material, it's very important, or it's moderately material, it's something in between. If it's immaterial, we'll give an unqualified opinion. If it's moderately material, we'll give a qualified opinion. And if it's highly material, we'll give an adverse opinion or a disclaimer of opinion, depending on the circumstances. When we're doing the audit, any material misstatement that comes to our attention, we will bring to the client's attention for them to correct it. And if they refuse to or are unable to correct it, then we will issue a qualified or adverse opinion. But any misstatement that we come across, we'll bring that to the client's attention and say, hey, This is misstated. We need you to correct them. Sometimes we will suggest some corrections to the client. Maybe they're not aware of something that is misstated. And if they correct it, we will issue an unqualified opinion because the item is no longer in question. If they cannot,
Professor,
yeah, go ahead.
which one did you say that you will issue an adverse opinion?
If it's highly material,
So if it's in, if it's immaterial, then you issued an unqualified opinion.
right. If it's moderately
And then if it's
material, you will give a qualified opinion. And if it's highly material, you will give an adverse or disclaimer of opinion depending on the circumstances.
thank you.
Okay? Any other questions before I go on? So if something is moderately material or highly material, you will bring it to the client attention for them to correct it before you issue your audit report. And if they're unable to correct it for whatever circumstances or whatever matter, then you will have to issue a qualified or adverse opinion. If the client corrected before you issue your report, then you still issue an unqualified opinion because the item is no longer in question. Figure 9.1 gives you some steps in applying materiality. You will set materiality to the financial statement as a whole. You'll determine performance materiality. You'll estimate the total misstatement in a segment. You'll estimate the combined misstatement. And then you'll compare the combined estimate with the preliminary or revised judgment about materiality. Basically what they're saying here, as you come across small misstatement, an item may be small, it may be immaterial by itself. Let's say we consider 100,000 to be material in the financial statement. And we come across an item of $10,000. Well, that's not material, we would not consider it. What they're saying that we should accumulate all our immaterial items and add them up because together they may be more than the $100,000. And if together they're more than the $100,000, then we have to issue either a qualified or adverse opinion, depending on how material we think they are. So when they talk about the preliminary judgment about materiality, when we go to an audit situation, we look at the client financial statement, and somewhere in the back of our head, we said, you know what? This amount will be material. How do we come across with that amount? It's based on the auditor judgment. It's based on the auditor experience with the company. It's based on the auditor experience in the industry. So the auditor sets a preliminary judgment about materiality. Some preliminary amount that the auditor deemed to be material. If the auditor come across small misstatement, they may not consider them by themselves to be material, but they will keep account of all the small immaterial misstatement. And if you aggregate them, they become over that threshold, then it's considered material. So let's say you go into a client and you look at the client financials and he says, oh, this is a small company, 10,000 might be material. Well, you come across misstatement of 1,000 somewhere, 5,000 somewhere else, 5,000 another place. By themselves, they're not material, but together you add them up. 5 and 5, 10 and 1, 11,000 is more than the 10,000. So it becomes material. So not because you come across small errors, you'll ignore them. You will keep a tally of the small errors to determine if combined, they are material. So make a preliminary judgment on what amount to consider material. Based on the auditor experience, based on the auditor knowledge, and their judgment, they will set a threshold of what amount is material. So the auditor set materiality threshold early in the engagement. Threshold represents the maximum amount that the statement could be misstated and still not affect the user decision. Again, how we come about that? A lot of what we do in auditing is based on the auditor judgment. Materiality is a relative rather than an absolute concept. Let's say we look at cash. There's $1,000 misstatement in cash. We consider 10,000 to be materially misstated. So if that's an error, it's not material. What if that's an irregularity? Errors are unintentional mistakes. Irregularities are intentional misstatements. Now, if that's an irregularity, if somebody stole that $1,000, it's now become important because theft are illegal. Right? So that's what we mean by it's a relative rather than an absolute concept. We do not only look at the absolute amount, we look at the circumstances under which it occurs. And benchmarks are needed for evaluating materiality. What are the benchmarks that we look at? We look at current asset or total asset. And we talk about the qualitative factors also affect materiality. Quantitative factors, what are some of the qualitative factors? If they fail to meet the loan covenant because of that misstatement. If it's changing the trend because of that misstatement. If it's affect management compensation because of that misstatement. If it concedes an illegal act. If it will affect the financial statement users, then it becomes important. So although it may be small, it will be important if it affects these areas. Accounting and auditing standards do not provide specific materiality guidelines. Those guidelines are developed by the auditor based on his or her professional judgment. So as auditors, we need to have good professional judgment. Judgment is extremely important in auditing. Determine performance materiality during planning. We will segregate the financial statement into segments. And we will take our materiality. Let's say we say 10,000 is going to be material. We'll break that up into segments. How much materiality will we tolerate in cash? How much materiality will we tolerate in accounts receivable? What amount should accounts receivable be misstated before we consider it material? Most practitioners allocate materiality to balance sheet accounts. This is something you are not going to master until you start actually doing audit. So when you go into your first audit, when you graduate from York and you start working for a CPA firm and you go into your first audit, these are some of the things you may want to review. As you're going through the course, you want to mark up certain things that you need to review when you're going back into your first audit. And I'm sure when you go to the firm will have practices that review these things with you. In the audit program itself, they will go through all the steps of calculating the materiality thresholds. So there's going to be a lot of guidance that's provided to you on the job. Some of the things that we talked about in auditing, if you do not feel like you master it, that's fine. That's very true for almost every accounting major that takes an auditing course. Even I was doing auditing. I did not feel like financial accounting. I know I master consolidation. I do not feel like I master auditing. Why? Because a lot of what is have to do with your judgment, and that will be developed on the job. We try to give you the preliminary concept, and when you get on the job, you'll have to apply it. So it is an art, it's not a science. It's not like financial accounting. You take revenue minus expenses, you're going to get net income. It's a lot different than that. Use materiality to evaluate audit findings. When the auditor can determine the misstated amount in an account, it's a known misstatement. Two types of likely misstatement: judgmental differences, which is based on the auditor judgment, and projections of misstatement from audit samples. A lot of what we do in auditing is based on sample. We do not test 100% of the transaction. We may just test 5% of the transaction. And based on the error that we find on the 5% of the transaction, we will project that error to apply to the whole population. So we may have errors. If you have a bad sample, we may have errors in the sample itself. So one of the keys to a good audit is to try to select a sample that represents the population. So when you did Economics 220 statistics, you talk about about sampling. And when you sample, you try to gather a sample that represents the population. Now, we're going to move on to conclude by talking about a little about risk. When we talk about risk, we talk about uncertainty, and the auditor accepts some level of risk in performing the audit. Risk exists in anything that we do in life. They're difficult to measure and require careful thought in response. Proper risk response is critical to achieving a high quality audit. Think about this. On a normal day, you're driving from your home to school. There's some risk involved. There's a risk involved that you're involved in an accident before you get to school. You don't know what that risk is. You don't know how much that risk is. You don't know to calculate that risk, but you know that there's a likelihood that you will get into an accident. So we talk about risk, we talk about likelihood of something occurring or not. Now you could make that risk smaller by driving carefully, observing all the traffic signal and the speed limit. That risk will not be gone, it will be mitigated. It will be made smaller. Or you could make that risk larger by boring all the stopping lights, speeding, boring all the traffic signals, and also if it's snowing, that risk will increase. So risk exists in anything that we do in life. Our job is to manage risk. Now, on the auditor job is to manage risk, is to lower that risk to an acceptable level. Now, we're going to define some risk here. Let me see what page they are in your textbook. Page 271 in your textbook. Plan detection risk, the risk that the auditor will plan to detect, the risk that the auditor will fail to detect certain misstatement, although the audit was properly planned and executed, although the audit was in compliance with GAS. Inherent risk. Inherent risk is there in anything that we do. Without considering internal control, the risk that the financial statement may be misstated before considering internal control. Control risk is the risk that certain errors or irregularities will not be detected by the client existing system of internal control. An acceptable audit risk is how willing the auditor to accept the fact that the financial statement may be misstated, although they have done a proper audit in compliance with generally accepted audit standards. And this is where I want to stop. This is all I want to cover in this chapter. You should know these 4 risks and how to define them because they will reoccur in chapter 11 and 12. Okay. The other things in this chapter, not that they're not important, but not at this stage of the game. When you start working in auditing, you're going to see them again, but you're going to have more aids to help you calculate and understand them better. So I'd like to close here. I'm going to stop sharing my screen, and are there any questions? Okay, so that's where we stop in chapter 9. Those are the only things I want to cover. Materiality, risk, what is risk, and the definition of these types of risk. Any questions? I'll talk to you guys again on Thursday. We're going to talk about chapter 11 and chapter 12. And those are the 2 last chapters we're going to cover in this course, chapter 11 and chapter 12. Question, Fabrizio? We good?
No, I was just saying have a nice day. Yep.
You all have a wonderful day. And don't forget your exam will be on the 25th, okay, at 10 a.m. Now, that's not the date that's set by me. That's the date set by the registrar, okay?
Professor,
Yes.
did you release the homework on Blackboard?
I think I did. I'll check again. I think I did. I think it's set up.
I
I don't
don't
think it's on
see-
Blackboard. It's in an email. That's where I see it.
But if you go on
Yeah,
Blackboard,
but
I don't think it's on Blackboard.
nowhere
It's
to post it on Blackboard.
like it said an announcement, but I don't see it under announcements in Blackboard. But I have like an email for it.
Yeah, but there's nowhere to post it. 'Cause it
Oh,
It
that's
has-
what you mean. That's what you mean.
let me get back in there. Hold on, let me see. Oh, I guess I didn't. Okay, I'm gonna release it today. Okay, I'm gonna open up all the homework today. Okay.
Okay, Professor, thank you.
Yeah, I'm gonna open up the homework today. Okay, I thought I did. All right. So everybody have a wonderful day, and do your homework for chapter 8 and 9. All right.